It's Friday, 13th of June, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, why global supply chains can't break their addiction to Chinese rare earths. But first, Neil Shearing, Group Chief Economist, joins me to run through the big issues in global macro and markets. Hi, Neil.
Hi, David.
We are just hours after news of Israeli strikes, military strikes on Iran. Iran has been striking back with a wave of drones. The world is once again watching the Middle East to see what unfolds, with the usual caveat that it is 9:45 in the morning London time. This is a very fluid situation, but just from a global macro perspective, what should investors be mindful of? What are you telling clients this morning?
Yes, exactly. Woken up again to kind of alarming headlines, haven't we? There's a couple of points, and clearly when there's any military conflict, economic and market considerations fade a little into the backdrop. But I think there's a couple of points just worth keeping an eye on. The movement in the dollar this morning, I think, is interesting. Dollar is up. That suggests that despite speculation that all the shifts in policy in the US have undermined the dollar's safe haven status, I think that is slightly premature in terms of declaring the end of the dollar safe haven status. If you look at moves in currency markets this morning, as I say, dollar up. Also, the oil price, obviously the oil price up. Currently, it's about $74 a barrel on Brent crude, up from just below $70 a barrel this time yesterday. Lots of kind of breathless headlines about the surge in oil prices. It's clearly a big jump, but worth keeping in mind that those oil prices are still 12% below where they were this time last year. So there has been a big downward shift in energy prices over the past 12 months. Now, what should we keep an eye on going forward? We're going to be holding a client briefing, a drop-in the next hour or so, late morning time in London, very early morning time, East Coast in the US. We'll get into this. But clearly, beyond the question of whether this conflict escalates, the key issues are, will any Iranian oil facilities be affected by these strikes? And in particular, I think the big fear in energy markets is not necessarily Iranian oil facilities, but what happens to shipping through the Straits of Hormuz if this spirals and spreads into a broader regional conflict. It's interesting that not just oil prices up this morning, but natural gas prices up as well, which might reflect concerns about potential disruptions to shipping through the Straits of Hormuz. Of course, lots of natural gas from Qatar shipped through there. So does the conflict escalate? Does it start to target Iranian oil facilities? Does it threaten shipping through the Straits of Hormuz? Big picture here, of course, is backdrop of, as I say, a glut of global energy, big spare capacity within OPEC Plus. At the start of this year, we thought that OPEC Plus was sitting on spare capacity of about 6 million barrels per day. Our forecasts assume that spare capacity will be reduced to about 3 million barrels per day as a result of supply increases over the next 6 to 9 months. So there's still a bit of slack left in global energy markets, but we're eating into that as OPEC Plus ramps up production. And clearly anything that disrupted supply as a result of this conflict, either because it affects Iranian production or, as I say, shipping through the Straits of Hormuz, would add to a picture of a tightening market.
As you say, we are doing a briefing for clients on this issue soon after this recording, and I will be sure to add a link to that briefing to the podcast notes, along with links to the key macro market written analysis that the team's producing as we speak. Back to our semi-normal broadcast, because US inflation data over the past few days, it looked pretty benign on the surface at least. Until this morning, I'd have asked you if that made the case for the Fed to cut rates when it meets in the coming week. Trump wants his 100 basis point cut like yesterday. And the Fed has been citing uncertainty around tariffs. Obviously, this what's happened overnight. I presume that adds another layer of uncertainty. So putting that all together, how does the FOMC meeting in the coming week play out? What should we be watching for?
Clearly, an enormous amount of uncertainty as to how events in the Middle East will play out, but I don't think it will have a major bearing on monetary policy in the US and what the Fed does next week, unless it really starts to escalate. So at this juncture, I don't think that's going to be much of a consideration for the Fed. Instead, they're going to pay far closer attention to what's happening in the US economy, both in terms of real activity and the labor market, but also, of course, inflation. And as you suggest, conflicting or slightly conflicting signals over the past week. It's fair to say the economy itself is holding up reasonably well, I would suggest. If you look at the payrolls numbers we had late last week, that suggests that the labour market's in reasonable shape. Certainly no big push for a rate cut coming from the labour market. And then we had the inflation data for the past week, which have been softer than expected. So if you look at the Fed's preferred measure of inflation, core PCE, a target consistent reading in May, when we may have expected the first signs of tariffs starting to push up inflation coming through in the May data, but no sign of that yet. So inflation data saying, yeah, there could be some space for a cut, but the real economy not really screaming that it needs one. I think you put that together with all the general uncertainty around policy, and the Fed, I think, on balance, stays on the sidelines. This doesn't look like an economy that, despite pressure from the president, desperately needs rate cuts at this juncture. And then, of course, on the fiscal front, we've got that bill working its way through Congress that, as we've discussed, would put deficits, the federal budget deficit, somewhere between 6 to 7% of GDP, depending on what you assume on tariff revenue over the coming years. So large deficits, loose fiscal policy, that would also argue for comparatively tighter monetary policy. So I think at this juncture, Fed on the sidelines.
And I guess just going back to that inflation news, to the extent that tariffs will feed through to higher inflation from the companies we've heard from, such as Walmart and Nike, all indications are that those price rises will come sort of this month-ish. So they wouldn't have fed into the inflation data that we've seen over the past week.
Yes, I think so. One of the questions we've had most often from clients over the past week is, when will we start to see the inflationary effects of tariffs? And it's incredibly uncertain, particularly when you think about how these inflation series are put together, at what point in the month those surveys are conducted, and then how that feeds into the monthly inflation data. Saying it's going to be in May or June or July is incredibly difficult. But if you take a step back and think about the logic of front running of tariffs, which we have seen some evidence of. We've got that big jump in imports to the US in March and some inventory accumulation. We've subsequently, our China team have been tracking rerouting by Chinese exports through third-party countries to the US, and that seems to be picking up too. So the logic of all of that would suggest that the global trading system is finding ways to cushion the effects of tariffs at this stage, which would of course mean that it's going to take a bit longer to pass through into inflation. But for what it's worth, we've always had in our inflation forecast that we'd start to see an increase in prices as a result of tariffs from around June time, which, as you say, in the coming months' data, but it wouldn't be a great surprise if it didn't come till early July.
Speaking of July, Treasury Secretary Bessent in Congress this past week saying that he believes that there could be an extension as we approach this July 8th expiration of the tariff pause. There could be an extension of this pause for those countries that the US is negotiating with. I think he cited 18, said there could be a one-size-fits-all regional deal for smaller countries who do less trade with the US. What does all of this signal about this July 8th expiration date? Do you think there's a chance it could be a relative non-event?
There's a chance. I think the biggest issue, actually, from the perspective of markets, is not necessarily what happens on July the 8th, but what happens on July the 4th, 5th, 6th, 7th, the extent to which markets are left in limbo, not knowing what's going to happen on July the 8th. And that uncertainty will be a breeding ground for greater volatility in markets, I think. So I suspect on balance, yes, as Secretary Bessent has signalled, it's likely that for most countries there will be an extension to the pause in tariff increases. But if the US waits until the 11th hour before announcing that, then we could still see some big shifts in markets over the coming weeks as fears that the clock might be allowed to wind down start to intensify.
Before we move on, just very quickly, headlines suggesting that, okay, so the Supreme Court says that Trump can't fire Powell, but he could name a shadow Fed chair. So they named Powell's successor ahead of the end of Powell's term in May next year to somehow shadow the current chair. How does that solve Trump's apparent problem with a man that, I mean, it should be remembered, a man that he appointed because he wasn't happy with the previous Fed chair?
Yeah, a lot of that gets forgotten, doesn't it? And at the time, there was fears in the market that Powell was going to be Trump's man, and that could undercut the US bond markets. Not turned out that way. I think to some extent that's the point. When you look at the kind of politics of of the Fed and how interest rates in the US are set. The Fed's a democracy, effectively, and the FOMC chair is just one voice in that democracy. So even if Trump was successful in inserting his own person at the Fed, then that wouldn't necessarily mean that the Fed would cut interest rates by 100 basis points or so, as he suggests he wants. I think there's a more general point to make about this idea of a quote-unquote shadow Fed chair, the idea that there will be someone lurking in the background trying to direct monetary policy from the sidelines. It will be pretty ineffective, clearly, but to the extent that it was someone influential, like Secretary Bessent, for example, I think it's going to end up doing more harm than good, frankly, because it starts to undermine confidence in US policymaking to start off with. And to the extent that there's any concerns about Fed independence being eroded, then we're just going to see another increase in the term premium on US government bonds and a rise in US bond yields as a result. Of course, that tightens monetary conditions and financial conditions, which is exactly the opposite of what President Trump wants. So I think in some senses, any move to have some kind of shadow Fed chair would just be entirely self-defeating.
Okay, I know you need to get ready for the briefing, but before you do, I did want to ask you, and I think it's probably a sign of just the news cycle in which we are working, that those US-China talks in London, which ended on Tuesday, feel like they happened months ago. But there is lots of speculation about what the outcome was. There's the usual trumping on Truth Social about how great the deal that got done was. But what was actually achieved here?
Relatively little, if you look into it. It's worth having a read of the take by our chief Asia economist, Mark Williams. He published a note earlier this week, really unpacking the quote-unquote deal. And the key point there was there's not much detail here, which has led me to thinking about why is there so little detail? And I think, as is so often the case, the simplest and most obvious answer is normally the correct one. And in this case, I think it's that both sides have been unable to find solutions to the core issues that have led to the breakdown in the US-China relationship. So yes, we've seen some loosening of restrictions on Chinese exports of rare earths, but only for 6 months, but according to some reporting. So China clearly wanting to retain some leverage there. And yes, we've potentially going to see some loosening of US restrictions on exports of things like jet engines to China. But again, I suspect that could end up being relatively time limited if these fundamental strains start to re-emerge.
So the key takeaway here is that nothing fundamental has been resolved. We're back to where we were in Geneva, and that all suggests that things could go wrong again. And watch this space.
It suggests that things could go wrong again. It suggests, as I say, that the fundamental issues have not been resolved. And actually, it really suggests that some of the kind of hot takes around these talks are just fundamentally wrong. Lots of headlines about restrictions on trade between the US and China being rolled back and that this is a win. But don't forget that the restrictions on trade between the US and China today are far greater than was the case at the start of this year. If you look at tariff rates, if you look at other kinds of export controls, far greater than was the case at the end of January. So yes, there's been a kind of it's good that both sides are talking, but restrictions on trade between the two countries are still far greater than was the case a few months ago. And this kind of somewhat flimsy deal, I don't think, is the last word.
Neil Shearing there on US-China relations, Trump, the Fed and tariffs, and of course this developing situation in the Middle East. As I said in my chat with Neil, you'll find resources on that in the podcast notes. If you did miss our briefing on the Israel-Iran strikes, you can watch a recording of that via the links. I will add some analysis of those US-China talks, of our preview of this coming week's Fed meeting, and Chief North America economist Paul Ashworth's note from a few months ago about Fed independence. That Israel-Iran briefing is a drop-in. These are our short-form online briefings that are designed to get you the answers you need in as little time as possible so you can get on with your day. We run several drop-ins each week, including in the coming week on the chances of the Swiss National Bank taking rates back into negative territory, and our regular wrap-up of the Fed, Bank of England and ECB policy meetings. Details of those you can find on our events page. We also have a drop-in session this Wednesday to highlight key takeaways from our latest Latin America outlook. As I mentioned on last week's podcast, our Europe team was recently named the most accurate forecaster of Germany's economy. In fact, this year we won more forecast accuracy awards from Focus Economics in their annual analyst awards than any other provider in the market. We are continuing to celebrate that success with this Wednesday's session, where Kimberly Sperfector, our Latin America economist, who was named most accurate forecaster for Mexico and Chile, among others, will be leading the discussion of what we're expecting from those economies through the end of this year and into 2026. Full details about that session are in the show notes. Now, as Neil mentioned, China's domination of rare earth supply was at the heart of those US-China talks. Rare earths are critical for supply chains. Apparently, you can't make a BMW 3 Series, an F-35 strike fighter, or a Virginia-class nuclear submarine without them. So what's the outlook for Chinese supply, and why can't producers just go and get non-Chinese rare earths? I spoke to Hamad Hussain from our commodities team about the situation, and I started by asking what these latest US-China talks signal about the supply-demand picture.
The latest deal was a bit of a reprieve for industries like the auto sector, which use rare earths as inputs. But it's important to remember that the deal was not as much of a victory as Donald Trump may think, and is only temporary. So, for example, the export control system that China operates will remain in place, and it will only rapidly issue licenses to US firms over the next 6 months. So while demand for rare earths will probably jump over this next 6 months as firms rush to beat the term limit, supply would probably become constrained again as rare earths return to the center of this US-China rivalry. Also, the deal does not alter the bigger picture, which is that China is very dominant in this arena. For example, China accounts for about 60 to 70% of mine production of rare earths, and more importantly, it accounts for 90% of refined production. So they also dominate in downstream industries like producing rare earth magnets, and then even further down, producing electric vehicles and wind turbines which use these magnets. In fact, the scale of Chinese supply in rare earth and critical mineral markets has meant there's been little economic incentive for firms in the West to develop their own supply. Perhaps the influence of an uncertain geopolitical backdrop and the resultant rise in prices could start to change that.
Talk about that, because as you say, it sounds like there's now going to be a mad scramble to hoard supplies, to build up inventories. If you're making cars, if you're making missiles, if you're making nuclear-powered submarines, you need these critical inputs. So what do you expect to happen over the next 6 months? Is that 6-month license limit? Is that China imposing leverage and we can expect talks to try and ease that, to push that back? What's the next 6-month picture going to look like?
Yeah, one would expect that governments would probably start to make preparations, perhaps for the end of this 6-month term limit, particularly spend a lot of time and resources into developing their own supply. But it's worth considering that this is an issue that's gone on in the background for many years. For example, the Department of Defense in the US has been the largest investor in domestic rare earth supply, given its use in military equipment, and has been allocating significant sums of money over the past 10 years into that. One fact that's been making the rounds in the financial press has been that an F-35 fighter jet requires more than 900 pounds of rare earth, which, I mean, that sounds like a lot. So you'd obviously hope that there would be a lot of effort going into planning and developing these resources. But of course, the issue is that it will obviously take a lot of time to build out your own supply. So in the meantime, what's more likely is that governments perhaps won't be prepared for the end of the 6 months and still will end up in the same place that we are at the end of this year.
What does the supply picture look like outside of China?
So there are reserves of rare earths in Brazil, India, and Vietnam. Vietnam has emerged as a smaller producer of rare earths in recent years, but the issue has been that the economics of mining and extracting these rare earths from some of these countries that are considered to be geopolitically aligned with the US. So the issue has been an economic one, in the sense that Chinese supply has flooded the market and it doesn't make sense to extract resources from these countries. So I think that outside of China, the supply picture is very underdeveloped, and it will probably remain like that in the near term.
This isn't the first time China has cut the world off from supply of rare earths. 15 years ago, the Chinese government very quietly cut off supply to Japan as that relationship was going through one of its relatively frequent bouts of tension. Talk a bit, would you, about how instructive that experience is in terms of what's happening today and how buyers of rare earths respond to sudden cuts in supply?
Yeah, I think there's one key takeaway from the Japanese experience, and it's that it's possible to diversify mineral supply from China, but ultimately it takes time. At the time of the diplomatic incident which caused Japan to lose access to Chinese supply of rare earths, only for a few months, China accounted for about 90% of Japanese imports of rare earths. This fell to as low as 45% in 2018, as Japan invested in Australian and Vietnamese supply of rare earths. Of course, the fact it didn't go to zero perhaps shows it's very difficult to completely cut China out of the picture, but the fact that Japan was able to reduce reliance on China to some extent does offer a valuable lesson to Western governments today.
That was Hamad Hussain on China's rare earths stranglehold. The team has analysis all about this situation, which I'll also add to the show notes. But that's it for this week. Obviously, there's loads going on. Our platform is the place to stay up to date with the latest written analysis, online briefings, and our Q&A platform to get answers to specific questions direct from the team. If you need to talk to one of our economists to get into the weeds on any issues in global macro and markets, do get in touch and we can quickly arrange a meeting. And if you're not yet a subscriber to Capital Economics, why not drop us a line and we will get you set up pronto. sales@capitaleconomics.com. That's sales@capitaleconomics.com. But until next time, goodbye.